Every time you say the word whole life, people kind of back off. It's almost a swear word, or almost if you don't want to talk to somebody, you just say, they ask you, hey, what do you do? Oh, I sell whole life. Oh, great. Then they're gone. What's going on, everybody? I'm Chris Naugle, and welcome to the Money School podcast, where we talk about the truth about money. My guest today is going to blow your mind. Not only is he a PhD, but he's been in this industry, in this space for a long time, but he doesn't work so much with you. He works with people like me. He's literally built a career out of helping advisors understand the finite, well, I'm not going to call it a science, but the finite details around whole life, but not just whole life. His PhD is in retirement income. And and I'm going to have him explain who he learned that from, but somebody who's very famous in our industry. But my guest name's Tom Wall. Look him up, get his book, Permission to Spend. How about the name of that book, right, folks? Permission to Spend. How many of you want a permission granted to you to spend your money? Right? That sounds pretty good. It's like a hall pass when we were in high school. You only got the hall pass and you're like, woohoo! Well, now you're going to get the hall pass to spend your money, and you're not going to have to worry about all the risks that come along with it. That's some of the things we're going to talk about. But we're also going to hit on whole life insurance. Oh, that dirty word. And we're going to talk about indexed universal life, commonly known as IULs. Welcome to the show, Tom.
Hey, thanks for having me, Chris. Good to be here.
Yeah, absolutely. Well, let's just dive right in. So talk a little bit about your PhD, because I just think, we're talking offline a little bit about being a specialist, and I think there's a lot to unpack about being a specialist, but the easiest way to say it is, if I had a heart problem, I wouldn't want to go to my general physician and have my general physician operate on my heart. I'd want to find the best in the business who's done thousands of that particular operation, a specialist that knows how to fix my heart. And you are that specialist, and you've got all the credentials to back it up. So let's just start with some credentials.
Yeah, so I started in the business 21 years ago as an agent and advisor, selling life insurance before getting into the financial planning and wealth management space. And I immediately, once I got a basic understanding of everything, I immediately became fascinated with the concept of what's known as the 4% rule and then what you can spend in retirement. And really, it's one of the biggest puzzles, I think, in financial planning, where most people are just blindly throwing money into their home equity and their 401k without any thought of how it comes out. So there's people that are retiring with millions of dollars, but they're afraid to spend because they don't know how long they're going to live. They don't know if they're going to require expensive ongoing medical care, long-term care that their health plan doesn't cover. What if there's another Great Depression, World War III, fill in the blank, or you live 60 years because people are living longer now with medical advances. All those what ifs just are causing people to hoard their wealth. Multimillionaires are living on, less than $100,000 a year because they're terrified of spending their money. So I got really fascinated with, some of the products, some of the concepts, and some of the strategies that you can use to basically give yourself permission to spend because you've mitigated all those risks. And that's where my academic studies just continue to go year after year throughout my career with various roles in home offices and all throughout the industry.
Yeah, and folks, me and Tom met. Actually, he didn't know anything about me. I saw him speak at it was a peer-to-peer event that was put on out in Colorado, and it was a phenomenal event. The And Asset is another book you should check out if you're looking for good books. But I heard him talk, and in his talk, he kind of hit on all those topics, but he really honed in on whole life insurance as an asset class and IULs. So with that, a lot of people, when they hear the word whole life, like it's almost like a swear word. Like, and I know you know this, you've been doing this literally almost exactly as long as I have, or maybe even, we're literally probably talking days, weeks, or months, as who's been in the industry longer. But every time you say the word whole life, people kind of back off. It's almost a swear word, or almost if you don't want to talk to somebody, you just say, they ask you, hey, what do you do? Oh, I sell whole life. Oh, great. And they're gone. Like, what is it that has given whole life such a black eye? I know maybe it was the 80s, when all that stuff happened and the market shifted to universal life, which completely, I'm not going to say it in the wrong way, but pretty much just blew up on itself. But where do you think whole life got a bad reputation? And then let's just talk a little bit about the economics of whole life.
Yeah, it's interesting. I don't think whole life actually has a bad reputation among those folks who are willing to take the time to understand it. I mean, there's a lot of talking heads out there. I won't name names, but we all kind of know who they are that say whole life is bad. They'll say things like, you're going to get 1% on your money over the course of your life. It's a terrible deal for you. The commissions are huge for advisors. When in reality, if you look at a money manager, they will, and their management fees, they will collect far more from a client over the course of their life, in fees and commissions.
Well, the SEC has a whole section on the sec.gov website that talks about how much those minor little fees that your advisor is charging you amount to over a period of time. Way more than any commission I've ever seen.
Yeah. And look, if we're being honest, there's a relatively low barrier to entry to be in our business. You pass a licensing exam and you can go out and sell whatever you want. And some people sell carriers that have not done so well. Some people sell products that are not exactly optimally designed. Some people are just, they come across as used car salesmen. So no one wants to talk to the life insurance guy, when in reality, I've worked with the best of the best in the business, advisors that just have massive multi-million-dollar practices that are on stage at these massive conferences and recognized. And these folks do tons of whole life insurance, and they do it but in a much more academic way, where they're solving problems versus just slinging a product. So I don't know exactly where it came from or how it became a dirty word. But I think, I don't want to call them bad actors. I think it's just uneducated actors, that are working with clients. I have found in my career that 99% of the people in this space are really out to do the best thing for their clients. But, just like a new doctor, there's a lot that they don't know yet.
100%. And a lot of the folks that do say bad things or talk down about whole life are usually selling, term insurance. They're the buy term, invest the difference people. And Tom, you haven't seen this yet. And you may or may not, but I'm happy to send it to you. We have literally completed a white paper. It's taken us about 4 months. One of my guys on my team, Craig, literally took it on as a project to mathematically, kind of like most white papers where you literally dissect it to its finite, just break it up into every little piece. But we took buy term, invest the difference, because everybody says that's the ultimate. That's the best way to do it if you want to accumulate money. And folks, any of you that don't understand that, what that whole thing is you buy a term policy to match whatever the term of protection you're trying to do. And you take the difference that you would have spent on a whole life insurance premium and you invest that difference over a period of time. And, and then they come up with a thing. And some of these egomaniac gurus out there that we were kind of alluding to early on, who will leave their names out, are constantly talking about this with no knowledgeable statements made about it as the best thing there is. Well, we have literally mathematically proven that if you take and you do the exact dollar for dollar S&P 500 period of time, exactly the same, so everything matched, whole life always beats buy term, invest the difference when you talk dollar for dollar. And all we're doing is we're talking about putting the money in the whole life, taking a loan out from the whole life for the max loan and putting that in the S&P 500 versus buying term and investing the difference in the S&P 500. And, I think it's going to really take the whole industry by storm, because nobody's ever really done this kind of an analysis of it. But that's who I think whole life gets the bad name from, because I hear it all the time. I had a guy, a hater as I call him, comment on one of my posts, and he said, "Oh, it takes 25 years just to get the money that you put into the whole life out of it." I'm like, what world are you living in? But that isn't the case. As a matter of fact, I think a lot of what you teach, and I'm just going to read it right off this, is you talk a lot about the interest rates and how whole life can almost act and almost, I don't want to say replace, but be almost like a bond-like instrument in a portfolio. So can we just talk a little bit about, number one, interest rates, because we're in a very unique time right now with interest rates. The Fed, to combat the inflation that they created by printing too much money, but anyway, we'll leave that out, raised interest rates very fast, up to 5.5% from almost zero. So a very quick increase, which drove bond prices way down, hurting some banks, which you remember Signature and Silicon Valley. Now, the Fed, because of this pressure that they're feeling, is going to probably start dropping rates, which is going to be a very unique thing. But in this crazy interest rate environment that we're in now, how will whole life hold up?
So that's a really big question. I'll go back to buy term, invest the difference. When you look at buy term and invest the difference, the first question I ask is invest in what? What are we comparing it to? Whole life insurance is backed generally by a major mutual insurance company's general investment account, which is largely made up of fixed income securities. So we're talking about bonds. They're investing in long-term corporate bonds that have 20-year durations or longer in some case. They'll typically own some subsidiaries that will add to their profitability, but essentially it's backed by a big bond portfolio, and it's a bond ladder if you kind of understand the concept of that. So what you're getting basically a rolling average of the long-term corporate bonds, which is typically the highest rate you can get for high-quality bonds. So why that matters is, if you're comparing buy term, invest the difference with buying term and then investing in the S&P 500, that's not even a fair comparison. First of all, so you got to talk about what you're actually comparing it to. So you should be comparing whole life insurance to your quote unquote safe stuff, money markets, cash, bond investments, things like that.
Yeah, we did it against savings accounts as well.
Yeah. I think if you could even add a little bit of risk like bonds, but going to your point, I did a lot of research around, interest rates and bonds. So if you go back to the 1970s, I think the Lehman Brothers was the first bond index, was widely known of, and the Barclays aggregate, I think, was 1976. The 401k was invented in 1978. So prior to this period of time, this last 40 years or so, as interest rates fell, most investors didn't have bond funds. They didn't have bond funds in their 401ks. They didn't own that kind of stuff. So we have all grown up in this period of time where bonds just could do no wrong. As interest rates started falling after 1981, that was a boost for bonds. Basically, bond billionaires, bond kings were born during this period of time because all they had to do was deploy capital and the asset went up. The bigger story, though, is volatility. If you look at volatility, bond indexes, if you look at them over the last 40 years or so, lost value about 1 out of 3 years, or I'm sorry, 1 out of 6 years. So it was relatively stable. It was the perfect hedge against the equity markets. They almost never went down together until 2022, when we saw everything lose value as interest rates rose. But if you go back in time, the prior 4 years, from 1940 to 1980. As interest rates steadily rose, bonds actually lost value a third of the time. So there was a lot of volatility, and your actual returns were maybe 1/5 of what you got during this modern era. So now, coming off of a low interest rate environment, which we haven't done for 80 years, and it's like you got to go back to the 1940s to find a rate environment as low as we're in right now. It feels high today because of a couple of years ago. It's still low. We really can only stay low for longer, go up. So the problem with that for a lot of investors is there's more risk in their portfolio than they may think, because they're looking back at the last 20, 30, 40 years of what happened. So that's the interest rate discussion is, interest rates, if they spike again, you're going to see some volatility in bonds. If they stay low for long, you're not going to get a lot of money in bonds. You're going to pay taxes on those bonds, and there's risk. So the thing with whole life insurance is it takes the risk off the table. It must go up in value every single year. The only question is how fast. How much did the company improve it with the dividend? The dividend essentially represents what bond yields are, but none of the volatility. And then it grows income tax free. And if you do it right, it'll pass with an additional enhancement with the death benefit to the next generation. All things you don't get with buy term, invest the difference. And the other key thing about buy term, invest the difference is, at some point, your term expires, and the whole concept of that is you're going to have this pile of money. So even if you believe that, you're going to have this pile of money, right? Your investments do well. You're not going to want to be 100% in the stock market the day you retire. Like, as you get older and get closer to those goals, you are going to want a larger and larger piece of your portfolio that is safe, stable, secure, not correlated to markets. And then, and in that case, where are you going to put your money? That's going to get you a good yield with tax advantages and have all those guarantees. So that's the key is the retirement income planning piece is, it looks good on a spreadsheet, the whole buy term, invest the difference, but we want to have allocations in our portfolio that are not tied to markets, that can't go down 30% because interest rates spike, that is basically insulated from a lot of the risks that market-based investments have.
So given that, why is whole life not used more for retirement planning? Like, why isn't and I know you talk a lot about this, and I've been definitely honing in on this, because as we kind of go into this next cycle, and I love that you mentioned the risk with bonds, and I think you said it, what'd you say, every 5 years or so, or every 6 years, 1 out of 6, I think is what you had said.
Yeah.
It ties almost perfectly to the short-term bond cycle, or I'm sorry, short-term interest rate cycle, not bond cycle. But with that, I mean, now we've got some serious cycles ending right now: short-term technology cycle and the long-term bond cycle, or the long-term interest rate cycle. God, this is what happens when you get up at 2:30 in the morning. Your brain is just a little behind what you're trying to say. So apologize, folks, but the long-term cycle. So now these are all kind of coming to an end. We're entering this really interesting period of time and a very controversial election. So next year, I think it's pretty safe to say the stock market and the markets are going to be incredibly volatile, all the while baby boomers are retiring in groves. So there's a lot of risk for retirees, and a lot of headwinds that they're about to face. So couldn't this guaranteed product be used to kind of help with some of those risks that retirees are going to face?
Yeah, 100%. I mean, from a cash value standpoint, I routinely tell people I think this is the best environment in about 80 years for an individual to own dividend paying, participating whole life insurance. And the reason for that is you can't think of things in a vacuum. You have to think of it relative to what else you can do with your safe stuff. So if we're comparing it to bonds, bonds are going to have volatility. They're not going to get huge returns. But with these insurance companies, what's happening now is for the first time is in decades, they've been able to make investments in long-term corporate bonds, their favorite investments, at higher and higher rates. So last year was the first year we saw some of these companies start to nibble at higher rates. Their dividend interest rates went up by, a tenth of 1% or a 20th of 1%. Or I'm sorry, 0.2 of 1%. So they're starting to move up. And that's what happens is, the interest rate environment takes a while to flow through. But I really believe that if you're showing whole life insurance today, there is a tailwind now for the industry. There's been a lot of the sales that came in, but also these insurance investment arms in deploying capital at higher rates than they've been able to, which should flow through. From a retirement income standpoint, though, like that's great for a volatility buffer strategy, having an asset that is guaranteed to go up in value every single year. The only question is how fast. Fully accessible. There's no rules like a 401k of penalties when it comes out. It's not taxed as it goes up, and eventually will pass to the next generation. So that's great to have as that tool. But actually, the angle that I've taken in my book, Permission to Spend, is, look, I love my kids. Like, my spouse is going to be, I can't rob my spouse of our retirement funds. So for me, that permanent death benefit guarantees that I leave a legacy to my kids. It guarantees that I replace my assets for my spouse in my retirement, so that I can go to my investments, whatever I'm able to accumulate, and just spend. I can annuitize them. I can spend them down to zero, knowing that I have an extra pile of cash that I can tap into if things don't go quite as planned. But also, moreover, is that the people that I love and feel obligated to, receive that. And that's kind of the whole concept of why people should own permanent life insurance, whole life being my favorite for a lot of reasons, in their retirement plans.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up.
Folks, listen to what he just said. So think about that, right? You retire, you amass whatever your retirement, nest egg is, call it a couple $1,000,000, and that's your money that you are supposed to sail off into the sunset on. Your final years, your final hurrah, right? That's when we're supposed to enjoy life to its fullest. And you got a couple $1,000,000, which should be enough for you to pretty much get done what you want to do. But then on the other side of the coin, you start thinking, yeah, but if I spend too much of it, if I spend it at the wrong time, if the sequence of my returns on this portfolio don't line up with my withdrawal rate, I'm going to go through all this money. And then I'm going to, if I die too soon, my wife and my kids aren't going to be able to maintain their lifestyle. So I'm going to have to just live like a I don't know, we're just going to have to take our standard of living down, downgrade the size of the house, downgrade the cars and all these things. Does that sound fun to any of you? Because that to me sounds awful. You work most of your life to amount, this money that you're going to use for retirement. And then all of a sudden you're scared to spend it because you want to leave a legacy because this money is going to be given to your family. Folks, this is buy term invest the difference, because buy term invest the difference, the term is gone or soon will be, because wherever you start that process of buy term invest the difference, the longest term policy you're going to be able to get is probably a 30-year term. Do you think you're going to live longer than 30 years? How about a 20-year term? You're going to live longer than 20 years? Some of you are like, no, I'm going to go before then. Really? You've had that discussion with God. He told you the day you're going to die. That's interesting. Like, I'd love to have that talk with him, but you don't know when you're going to die. But you know who does? The life insurance actuaries. They know exactly when you're going to die within a really finite science, like within a very close proximity of your death. They can predict you dying. And you know what they also know? They know that they're not going to pay out on that term insurance policy, actually less than 2% of the time is all they're ever going to have to pay out on, because they've done the math. You haven't. Okay, so now you're worried that you got to leave a legacy. And the cost to leaving that legacy is now you can't spend the money that you have worked so hard to accumulate. That's exactly what his book, Permission to Spend, says. Forget about leaving a legacy. Spend it all. Go on the trips. Get on the plane. Go to Mount Everest. Go wherever the hell you dreamt of going and spend it. Because you know what? When you die, no matter when that is, heck, you could even live past 121 and they'll just write you a check. Whenever that day is, your family is getting a big windfall, big death benefit, tax-free. You no longer need to worry about leaving money for the family. You can just go out and live the life that you've wanted to live all those working years. I think it's brilliant. And when you said the name of the book, I knew exactly what you were doing, but I didn't know that was the basis of it. I love it. Real quick, like, where do people find your book? Is it available everywhere?
Yeah, it's available on Amazon in all formats. And if you have any advisors, they can reach out to me or go to permissiontospend.com and you can buy them in bulk for clients, which is really what I wanted to do. I wanted to create some third-party material for the industry to be able to hand to clients and back up our story, because there's so little of it out there that actually I think talks about it in a positive way.
Yeah, no, I couldn't agree more. All right. So anything else? Like, I know you mentioned it, but can we just hit it just really quick? You mentioned volatility buffer. Now, folks, you may not know what that means, but just think of the stock market, right? It's up, it's down. Yes, I know it's been the longest bull run in history, and some folks don't even know anything about a down market, but there is one, and you're about to find out about it. But when the markets go down, it's a big drawdown on your retirement portfolio. If you're taking income from any investments and you're taking it when the markets are going down and your portfolio is going down, there's a very strong probability that you're eventually going to run out of money. So there's this concept, I guess that's what you'd call it, called the volatility buffer, where you then, when the market goes down, you don't take money from your invested assets, you flip it and you start taking money from a whole life policy that was built for this purpose. Do you want to hit on that a little bit?
Yeah. So I think, during the accumulation phase, pre-retirement, market volatility does not have to be a bad thing. In fact, when the market goes down 20%, guess what? The shares of those companies are now 20% on sale. Like, that's a great thing. If you're regularly contributing money to the market, that actually, it's called dollar cost averaging. It works in your favor. In retirement, it's the opposite though. It actually works against you, because what happens is if the market loses 20% and then you sell 5 or 10% of your investments beyond that, now you have a 25 to 30% loss, and it's just much harder to dig out of. So there was research done. I can't believe it's been 30 years, but William Benjamin was actually a financial advisor in 1994 he didn't mean to create the 4% rule, but he did some historical math on a 50-50 portfolio and said, had you started income in 1926, 27, 28, and every single year thereafter, what would have been the highest safe withdrawal rate that you could take in the first year of your retirement, basically the percentage of your portfolio, such that it would last for 30 years and you would get actual inflation adjusted increases. So I think in 1926, it was like 7%. 2 years later, it was 4.5%. 2 years after that, it was 8%. And the volatility of that safe withdrawal rate was all over the place. But the worst case scenario, I think it's 1966, was where he came up with 4% would have been the number. And that was the worst over the last 100 years. It's not to say that that's the worst going forward. The future does not have to look like the past, but that's what it was. And then just not even a generation later, 16 years later, in 1982, it was 10%. Or actually, I think it was more like 11. So it was almost 3 times the retirement. And that's the issue with retirement income planning. The two things that can really impact what your actual safe withdrawal rate is: inflation. Can't do much about that, but there are some ways to plan around that. And market volatility. So the volatility buffer concept basically says is, what if we had money somewhere else? And it doesn't have to be whole life, by the way. It can be cash under the mattress. It can be home equity. It can be a loan from your rich Uncle Steve. It can be whole life cash value. The point is, it's not in your portfolio. So if your portfolio goes down because of market return or bad market returns, you can take the next year off instead of kicking your portfolio while it's down and locking in those losses and exacerbating those losses. And I actually did research. I actually paid a data scientist to go back through that data set and say, and then tell me, what's the value of taking that year off? And just in a nutshell, for every year that you can take off or take money from somewhere else that's not correlated to the market, that's guaranteed to go up in value and accessible, you can see why we like whole life insurance. You can take about 10% more income safely as an initial withdrawal rate off the rest of your portfolio. So if you're taking 5%, if you have $1 million portfolio and you're taking 5% or 50,000 a year, you have 1 year that you can take off from somewhere else, that turns into 55. If you have 3 years, you can take, it's pretty linear. If you take 3 years off because you have 3 years of income from somewhere else, that turns into 65. Now we're changing your lifestyle. So that's the value of it. So the volatility buffer strategy basically says is stay invested. It's okay to own investments in retirement. In fact, it's encouraged, and every academic in the world would tell you that that's an optimal strategy. But if all you have is a volatile bucket of assets and 2022 happens and everything you own is down, and now you have to sell those assets to live because you got to pay the bills and you got to eat, then it becomes very hard to dig out of that hole. So for me, I prefer whole life cash value because it's going to get you the best yield over time safely. It's got tax advantages unlike anything else out there. There's also this springing death benefit value that's going to come up later on in life at some point, when you pass away for your family, which is above and beyond what you've been able to accumulate. I call it the inevitable gain of whole life insurance. And that just provides security. It's about risk. It simply shifts the risk from you to a pool of individuals, like, through the insurance company.
I love that you just said that. So the whole baseline for whole life is the risk is almost all on the insurance company. The only risk on you is you got to make your premium payments. That's it. Okay. Now, I want to change gears and talk about something that I talk about all the time, but I love the way you look at this because you take a different approach, more of an academic approach to this. There's this product that came out. It's not new, but it's relatively new if you compare it to whole life, called Indexed Universal Life, IUL. So it's the cat's meow in the industry right now. Every broker, every advisor that I come across, for the most part, is selling IULs. And I know the reasons why, but I'm going to let you do this. So if IULs are the new rave, just like VULs were the rave before 2008, just like ULs were the rave until interest rates started going the other direction. Anyway, IULs are the rave. All these shops are selling these things, pushing these things. Their advisors are being told to really sell these. Like, why IUL versus whole life, or why whole life versus IUL? What's the academic approach to this discussion?
It's a tough one. So, I mean, the pitch in the IUL space is you get upside potential with downside protection. And the downside protection usually comes in the form of a 0% crediting rate in any given year. So 0 is your hero. These are the terms that you see thrown around. So you can just right there, that sounds pretty good, right? Who doesn't want upside potential with downside protection? So that's, I think, why they're easy to position. In reality, these products are extremely complex. And the bigger issue is you're guaranteed basically nothing over time. The only guarantee is usually that 1 year floor. So if the market loses 30%, yeah, you're going to get a 0. That's great that year. But while while that 0 can be your hero that year, I like to say the cap is your trap. Because these policies have basically the way you're paying for that 0% floor is you're capped on the upside. Right now, it's around 9 or 10% for a lot of IULs. I remember not so long ago, it was 13, 14%. And that
Yeah,
right
so
there
the cap is a moving target. I do want to stress that because that's one thing that's never talked about. That cap isn't fixed. It's moves.
and it's often guaranteed to be as low as 2 or 3% if the insurance company chooses to lower it to that.
But nobody
Um,
reads the fine print.
Nobody reads the fine print, and really, what you're buying is you're not actually buying the index. You think that you're investing in the index, and the insurance company is just helping you around the margins. Well, the reason that you don't actually have to have a securities license to sell IUL is because they're not actually putting you in the index. The insurance company is buying a call. I won't get into the complexities of it, but they're basically buying a call option spread that lets them capture the returns of the market between 0 and 10% or whatever it is at the time. And then they credit that back to the policy owner as a crediting rate in this fixed insurance product. So you don't have to be licensed to sell this because you're not technically invested in the market. My issue with IUL is my issue with VUL is my issue with universal life of the 80s is it's not guaranteed. So for all the things we just talked about for the last half hour, we're talking about retirement income planning, shifting risk to the insurance company, guaranteeing a legacy for my kids, providing a bucket of assets that has to go up in value. The only question is how fast, fully accessible, so I can remain fully invested elsewhere. In an IUL, there is none of those guarantees. The insurance company can lower the caps on you. They can change. They can increase the mortality charges. The premiums that you're paying are based on an illustration up front, and if history doesn't play out like it has in the past, which is usually what the assumptions are based on, then now you're going to have to kick in more money to make it look like it was supposed to. And the insidious thing is once you get behind in an IUL, so let's say it's underperforming what the illustration said it was supposed to, it becomes very hard to catch up because of two things. One is the increasing mortality charges. Anytime you're behind what the illustration was showing, I know that your internal mortality charges on the policy are higher. Therefore, your returns going forward are muted. The other one is because of the cap. If you're illustrated 6%, 6%, 6% every single year, and you start to compound that, if you get a couple zeros in a row, and then think about what you have to earn to catch up to what was illustrated on that cap, you can't, because the cap caps you at 10%. You might have had to earn 20% to catch up to what you were supposed to be over that period of time. So they're just engineered in a way. And once you really understand how these insurance companies invest, your best case scenario in an IUL over a long period of time, 10, 20, 30 years, is probably what you're going to get in whole life insurance anyway, but without any of those risks or complexity. The only thing I can really say positively about IUL is where it might be a good fit is that you have true flexibility of premium funding. Like you can put in whatever you want, whenever you want, as long as those charges are covered. But I don't find a lot of people need that flexibility. I think most people can do a lot of that inside of a whole life policy, especially with some of the creative ways that these companies have allowed for riders to overfund it and things like that.
Yeah, I'm glad you hit that because I was going to jump right in. I was going to say, wait. I can do the same thing with whole life. I can design it to have any flexibility the client wants. I could literally say, hey, you want to put in 10 grand? Well, we can build it so that the floor is, $1,500. I mean, you can build a whole life with lots of flexibility, but that is definitely the big sales thing they use with those IULs is, it's flexible. But what they don't tell you in an IUL is the same thing they didn't tell me back when I sold lots of VULs and lots of ULs is that flexibility is also the devil, because if you underfund the policy, and listen, it is as flexible as you want it to be. If you underfund it, and then all of a sudden things change, like I had VULs, market conditions changed in 08. I almost lost my VUL because it almost lapsed. New York Life, luckily, was nice enough to kind of make it so that they couldn't lapse during that period, and it got back up. But, I definitely had issues. I saw them firsthand with my VUL policy. And it wasn't even because I was underfunding it. It was just the nature of how that thing worked. And universal life, gosh, you remember the old target date or not target date, I'm getting it, my words, but the target funded universal life policies. I had a period of time as an advisor. It was like a heyday where all I did is called on old target universal life policies to replace them because they were all failing. And literally the discussion with the client was simple. Hey, Mr. or Mrs. Client, yes, you bought this thing back in the 90s. It was awesome. I know it was supposed to have hundreds of thousands of dollars and be great, but it lapses next year unless you triple your premiums and put that in. So here's the solution. That's what we did. And what a terrible discussion to have with a client, right? They buy this protection for their family, right? And this protection is supposed to last their lifetime. And it's not only that, it's supposed to have all this money they're going to use to supplement their retirement. And then this guy they've never seen before shows up at their house to talk about this awesome life insurance policy. And the discussion is just like the one I mentioned. Your policy is going to lapse. Oh, no, you didn't do anything wrong, Mr. or Mrs. Client. You did absolutely nothing wrong at all. Matter of fact, interest rates were what went wrong. You see, back when you took this out, it was showing this interest rate, and interest rates have gone down, and now it's here, and it's not enough. And the client's already glazing over, sometimes tearing up. It was a sad period of time. But folks, listen, the same thing can happen to a universal life or an index universal life. The same thing definitely happened to VULs. You just got to be really careful. And I hate the way they're sold because they're sold like an investment, Tom. And that's the biggest thing that I have an issue with. There are so many IUL sales folks out there just doing it complete disservice because they're selling it on an illustration that you and I both know never in a million years will materialize the way that they illustrate it. But that's what they sell it on. Hopes and promises when the insurance company already knows they've shifted the risk from the insurance company back onto the client. And that's the good thing for the insurance company.
You know, the way I like to couch it is I know we started here. I really believe 99% of advisors are trying to do the right thing for their clients. I think they're trying to set them up for success. When you academically really understand how an IUL is priced, how the inner workings work, and then you play it out. You know, you realize because of, I won't get into the details here, your best case, I said it already once, but your best case scenario over time is maybe a little bit better than whole life would have done in terms of growth. But because the risk is on you, you're risking hundreds of thousands of your dollars or potentially more to eke out that slightly higher gain, which is going to be close to what you would have gotten in whole life anyway. Based on the way that these crediting methods are priced. So I don't see the point. But the other way I'll say it too is this is interesting. You know, one of the great things about permanent life insurance is the tax wrapper that you get. You know, you basically get tax deferred growth, you get tax-free death benefits, you have policy loans and a non-MEC policy that you can access. So you can access all this capital and multiply your money by many times and not pay income tax on it. That's true for all permanent life insurance. The difference with whole life, though, is, you know, if you buy a VUL, you're basically investing, the underlying investments are basically the same thing you can do outside of the VUL. It's a mutual fund, right? An IUL is a crediting strategy that you could actually buy options if you wanted to yourself. No one does it, but you could do it. You know, back in the 80s, you look at it was based on basically money market funds. You know, it's kind of what it was tied to, something you could do on your own. But the risk was always on you to make sure that worked. And if it wasn't working, you got to kick in more capital. With whole life, it's different. You will get bond-like returns over the course of your life because that's what the general investment accounts are invested in. But through the life insurance contract, they've guaranteed away the risks. They've guaranteed that they can't come back to you for more money. They've guaranteed that your cash values must go up in value. The only question is how fast. They're guaranteeing a death benefit. The only non-guaranteed component is the dividend, but they've been paying it since Civil War times. It's really more of a question of at what rate does that dividend come. So you think about it, you're actually getting a better bond. You're getting a better Sharpe ratio, a better risk-adjusted return is what the academics would call it, is how much return am I getting for a given level of risk? And there's really not much risk in whole life. Whereas you're not getting that in a VUL. You have the same or maybe more risk because of those mortality charges. So those are the two big ones, is risk and taxes. And that's, for me, philosophically why I own only whole life insurance. And because of that, I will be far more aggressive and shoot for the stars and have more efficient investments elsewhere longer. And I think that's optimal.
Well said. I'm just going to sum that whole thing up. You know, the reason to maybe look at whole life over an IUL is with an IUL, the juice is not worth the squeeze. And with that being said, folks, we're coming to the end of this podcast episode, but I do want to bring some real light to his book, Permission to Spend. You can go to permissiontospend.com. I'll put that in the description. Grab that book. If you're an advisor or one of our peers, grab a box or 2 or maybe 10 boxes of these things. Give this out to your clients. Listen, knowledge is power. The more your clients understand this, And the more that they can see how this works, the more they're going to come to you for that advice and for, the recommendations to put some more money into whole life if that's where you're pushing them to or what you're suggesting. But the other thing too that I want to bring up is something we talked about offline. Is one of the things Tom does is he works with advisors and agents and companies like mine, and he basically brings us through a process on a biweekly basis, working with us, bringing in top 1% advisors in the industry, and really talking about things like language and concepts and the ways that different vehicles like whole life or annuities can be positioned to reduce risk, just like we talked about today. So folks, if you're an advisor, get a hold of Tom. Tom, where would they go to talk to you about how you can coach them and their advisors?
I've always find LinkedIn is the best. Well, you can see a lot of the stuff that I post there, but wholelifemasterminds.com is the website for this group. And we've been growing by leaps and bounds where our sessions have been the hundreds on our calls at this point. So it's been a nice ride.
That's freaking awesome. Well, folks, I hope you've enjoyed this discussion on an academic level, little different than normal, but I loved it. And I hope you did as well. Join us for the wealth webinar. We're going to have Tom on there as well. It's every single Wednesday at 1 p.m. Eastern, totally free. Just register by going to chrisnaugle.com and you'll get the copies of our books. And maybe I'll work a deal out with Tom and grab some of his books so that anybody that's going to watch this wealth webinar with him, you get a copy of his book for free. With that being said, thanks for joining us for another episode of the Money School Podcast. See you next time.